February 7th, 2026, Malaysian ringgit per gram gold and silver, a rate-driven whipsaw, a 3-day stress test, and what comes next. Malaysia's Malaysian ringgit per gram spot market over the past approximately 90 trading days has been shaped by a single dominant narrative, a rapid rate expectations-driven surge into late January, followed almost immediately by a sharp and disorderly repricing. The move felt like policy credibility being reassessed in real time, but this time the pressure came from the US yield curve and the US dollar rather than from domestic political developments. What follows is a fact-checked Malaysian ringgit per gram comparison based on spot tables and daily historical data from Bullion Rates, aligned with contemporaneous market reporting on a hawkish, rate-driven repricing shock. Together, these data points frame how gold and silver responded to shifting macro expectations and how quickly positioning was forced to adjust. For gold, the verified highest current market price during the recent surge was approximately 681 ringgit to 682 ringgit per gram, recorded around 28th to 29th January 2026 on MYR per gram spot history. The verified lowest price within the post-surge 3 trading day window was approximately 590 ringgit per gram, recorded on February 2nd, 2026. This level represents the forced liquidation low that followed immediately after the rate-driven reversal. Silver followed a similar trajectory, but with greater volatility. The verified highest current market price during the recent surge was approximately 14.69 ringgit per gram, recorded on January 28, 2026. The verified lowest price within the 3-day post-surge window was approximately 10 ringgit and 4 sen per gram, recorded on February 2nd, 2026. As of February 3rd, 2026 at 1:15 UTC, the latest MYR denominated spot snapshot showed gold at 613 ringgit and 39 sen per gram, equivalent to 19,079 ringgit per troy ounce, with an intraday range of 590 ringgit and 48 sen to 613 ringgit and 98 sen. Silver was priced at 10 ringgit and 61 sen per gram, or 330 ringgit and 23 sen per troy ounce, with a day range of 10 ringgit and 42 sen to 10 ringgit and 67 sen. Using the last 90 trading days of Malaysian ringgit per gram closes as a working definition of recent history, both metals reached their peaks within the same narrow window. Gold recorded its highest close at 681 ringgit and 35 sen per gram on January 29th, 2026. Silver recorded its highest close at 14.693 ringgit per gram on January 28th, 2026, with the following day essentially flat at 14.666 ringgit. This synchronization strongly indicates a macro-driven move tied to rates and the US dollar, rather than to supply-specific developments. Within the same period, the most significant single-day percentage increases further highlight silver's greater convexity. Gold's largest one-day gain occurred on January 28, 2026, rising 3.37% from 658 ringgit and 22 sen to 680 ringgit and 42 sen per gram. Silver's largest one-day gain occurred earlier on December 26, 2025, when it jumped 10.22% from 9 ringgit and 36 sen and 27 to 10 ringgit and 32 sen per gram. The disparity reflects silver's thinner liquidity, heavier speculative participation, and stronger industrial beta during risk-seeking phases. The most recent surge culminated in the late January highs on 28th and 29th January, followed by a sharp reversal on 30th January and further weakness into 2nd February, the next listed trading day in the 90-day tables. For gold, the lowest close within this 3 trading day post-surge window was 590 ringgit and 48 sen per gram on February 2nd, 2026. For silver, the lowest close in the same window was 10 ringgit and 42 sen per gram on February 2nd, 2026, following an initial collapse to RM 10.735 on January 30th. This 3-day stress test matters because it distinguishes between a simple leverage flush and a more durable trend break. In this case, prices stabilized after the liquidation, but at levels far below their peaks, consistent with classic discount rate repricing. From a market sentiment perspective, gold's move was driven far more by global macro positioning than by jewelry demand. A rates-aligned rally carried prices towards 681 ringgit per gram before reversing sharply. The drivers were collective rather than singular, involving macro traders, systematic strategies, and hedgers responding to changes in US rate expectations and dollar strength. When expectations shift toward easier policy or lower real yields, gold benefits mechanically as its opportunity cost falls. When those expectations reverse, the unwind is equally mechanical. The repositioning saw profit-taking near the highs, de-risking as momentum broke, and a shift from buying dips to selling rallies. The rebound toward 613 ringgit per gram suggests cautious dip buying rather than a restored structural bid. Silver echoed the same pattern with greater force. Its dual role as a monetary metal and industrial input makes it a leveraged proxy for macro risk sentiment. When financial conditions tighten and the dollar strengthens, silver typically falls harder than gold due to more crowded positioning and thinner liquidity. The collapse from 14.666 ringgit on January 29th to 10.735 ringgit on January 30th was characteristic of forced deleveraging, followed by stabilization as the market searched for a new clearing price. In the short term, sentiment for both metals remains fragile, but is showing signs of repair. The bounce from the February 2nd lows reflects bargain hunting, not a confirmed trend reversal. If US rate expectations remain volatile and headline-driven, gold and silver are likely to trade as volatility instruments, with silver remaining the more reactive. Over the medium term, however, structural support remains credible amid persistent growth uncertainty, inflation risk, and ongoing questions around policy credibility. Gold continues to serve as a stabilizing hedge, while silver offers higher upside potential alongside higher drawdown risk. For MYR-based investors, the distinction remains clear. Gold stabilizes portfolios, silver accelerates them, and position sizing matters more than narratives.